The government is coming for your money. Shocking new plans that you need to know about right now. Now, the goal of most people is to create a good life for themselves and their families, and this typically includes getting a good job, starting a business, working really hard for most of their adult life while saving money in hopes of having a nice retirement one day. And the government continues to make this harder and harder, pushing this almost out of reach for many people today with their never-ending money printing that literally steals the value from your dollars you earn and save to sky-high asset prices on everything from food to clothing, housing, travel, assets, and it's still not enough. Now, they're proposing new plans to come and take your wealth. So in this video, I'm gonna show you 2 dangerous attacks that they are proposing right now to take your wealth from you and your family. Now, these very dangerous plans are going to have disastrous effects, and you need to know about them right now so you can make the appropriate plans to protect your wealth before it's too late. So let's go. All right, now before we dig in, if you're new to the channel, my name is Mark Moss, and I make these videos because I want to change the way you think about money, because almost everything that you have learned is wrong. And if you can learn just to see things differently, think about things differently, then you can have more freedom, more options for your life, for your family, and for your future. Now, if you like these topics and want to help me get them to a wider audience, help me one quick second, click on that like button so the algorithm sends it out to more people. If you're not already subscribed, hit the subscribe button and the bell notification so you're notified every time I put a new video out. Now, just real quickly, one more thing I want to say is that in just a couple of days, I am having a live presentation. I do this once a month or every couple of weeks where I go live for about an hour and I go deep into a subject, give you some actionable steps, and I'm going to show you that, regardless of what we see on the horizon, and it's not good, there is a way to bulletproof your portfolio for regardless of what's going to happen. I'm going to go through all of that. I'm going to explain that to you. There's a link down below in the description if you want to come join me live. Ask all your questions real while we're there and live, stuff that we can't say on YouTube as well. So click on the link down in the description below. All right, now let's go ahead and get into the video. All right, now let's go ahead and get started on this video. So today we are talking about the target, but really what we're talking about is the 2 attacks that the government is proposing right now to come and steal your wealth. Now, like I said, most people have similar wants and needs and desires, right? To build up enough money to one day retire, take care of your family and whatnot. Now, the amount that it takes for you to have that life that you want, right? To have that secure retirement, whatever that vision is for yourself, that amount, it depends on where you live. Now, this shouldn't be surprising. Of course, if you live downtown Manhattan in New York City, Beverly Hills in California, or extremes like that, then you know that it's gonna be way different there in the Hamptons than it might be in Kansas City, right? So that's obvious, pretty standard, right? But the reason why is because not only is the housing, but just the standard cost of living varies from place to place to place. Now, if we take a look at this, we can see kind of a good illustration. So these are states with the highest 3-month cost of living, and it would of course be no surprise California over here and New York over here being the highest. Of course, most of middle America right here is kind of the lowest. You have some good low prices through this through the South area as well. So if you're in any of these areas, obviously, like I said, the cost of living changes, and so then the target amount that you need for retirement changes as well. All right, now we can see that the amount that you actually need depends on many factors, but per Charles Schwab, they say for most Americans, 1.7 million is the magic retirement number. 1.7 million. So the reason why we're going to set the stage is because the attacks the government has, they are saying that they are for the rich. But what I want to show you is what is the rich. So the average for most Americans, they're going to need $1.7 million to retire. Now, I think it's actually more. Like I said, this is a survey from Charles Schwab. And the reason why I say it's even more is because the rates have gone down. This is the 10-year US Treasury. It's paying out about 1.6 right now. As you can see, this rate has basically gone down. We were at right here in 1982, we were about 16% interest. So that means if you had $1 million in the bank, you could make about $150,000 a year of interest. So you put $1 million in the bank, you have $150,000 a year. Now, most people, maybe you don't need 150, maybe you only need 75. Well, good news, you only need $500,000 then, right? The problem is right here, last year, this bottomed at 0.5%. half of 1%. So now how many millions of dollars do you need to survive? Do you need $100,000? Now they have come back up. Right now, like I said, we're sitting at about 1.6 at the time of this recording. But based off of that, on $1 million, if you do the math on $1 million at 1 times 1.6%, you're looking at, about $10,600 a year. Now, I don't know if you can live on $10,600 a year, but I can't. I can't live on $10,600 a year. Now, that is before taxes. So then you have to pay taxes. Now, I don't know what your tax rate is. Let's say that your tax rate is 40%, or to make it easy on my math, let's call it 50%. Now you end up with about $5,300 after taxes. Now, of course, if you pay 25%, you'd end up with about $7,000. Either way, $5,000, $7,000, $10,000, I don't think that is enough for you to retire off of. Now, on the 30-year Treasury, it's a little bit higher, but that I wouldn't get too keyed in on what the 30-year Treasury is. The point is, it's going like this, right? The Fed tells us that they're not even thinking about raising rates. So how is it that we're going to retire? Now, like I said, your financial advisors are going to go after this data. Well, historically, you could make about 6%, or maybe you need 4%. Well, that was okay a few years ago, but not today. Are they revising their data? All right, now, like I said, the government is coming after your money, and they're already taking their money as many ways as they possibly can. Of course, we have all these types of taxes, an incredible amount of taxes, income taxes, investment taxes, sales taxes, employment taxes. I mean, you name it. This is just one little sheet. I'm not going to go through this right now, but just to give you an idea of the average American's taxes that are paid. I mean, you name it: import taxes, health taxes, insurance taxes, interest taxes, vehicle registration taxes, business registration taxes, cigarette taxes, court fees, driver's license fees. I mean, we could go on, but I'm not going to. These are the main taxes that people have to pay. And so these are the ones that we want to take a look at, because these are the ones that they're talking about right now. So of course, most people are of course already paying their income tax, right? So on money that you make, your income, you're paying tax on that. But what about the capital gains tax, and then also this inheritance estate tax? So let's go ahead and take a look at those two and see what they got cooking for us. Now, let's talk about capital gains tax for a minute. Now, a lot of people maybe don't really understand what this is, and even if you think you know what it is, maybe you don't. But the way that you look at this is that capital gains tax is taxes that you pay on capital gains, which is basically investment income. If I buy a piece of real estate for $100,000, I sell it for $200,000, I have $100,000 of profit, I pay capital gains tax on that. If I buy a stock, if I buy Bitcoin or cryptocurrency, and I sell it later and I make money, if I buy gold, I sell it later, I make profit. On that profit, I pay cap gains tax. Now, the reason why it's always been a lower rate than your ordinary income tax is because we've already paid tax on the money. So I'm working at my job, I'm earning income, I'm paying income taxes. After tax, I decide that I'm going to be good with my money, I'm gonna save some, I'm not gonna spend it all, and then I'm gonna invest some of it at risk. And I've already paid tax on the money, I'm gonna put it at risk to hopefully help the economy, help other people, get myself ahead like I should, and then I have to pay tax again on the money, and then I make profit there, and then I go spend it, and then of course I have to pay sales tax. We're not going to go into that, but it's already been double taxed. That's why it's taxed at a lower rate. Also, if you've watched some of my other videos about taxation, we're going to have my editor link to them up here. You also understand that the government puts taxes in to get you to do certain things. So they need businesses to start and invent things and provide jobs. So if you start a business and you invent things and you give jobs, you get a break on your taxes. Now, in capital gains, there's two types of capital gains. There's short and there's long. So the 12-month is the break. If you hold an investment for less than 12 months, you pay short-term capital gains, which is basically just ordinary income. If you hold the investment for more than 12 months, then you pay long-term capital gains, which you get a discount on that. All right, now we can see this is kind of an example of this. So on ordinary income, the more you make, the higher you pay in taxes. So you'd pay at $500,000 of income, you pay 37% on your taxes. But on cap gains, even on the top tax tier rate, you're going to pay only 20% of the tax. So you've already paid 37% on the ordinary income, you invested it, you've made money, and then you're going to pay another 20% on that. But under the new plan, the new attack they have, they want to come after that money. Of course, you may have probably already heard about this. It rocked the market last week. Biden to float historic tax increase on investment gains for the rich. The problem is this definition of rich. All right, this is the problem with the definition of rich. And you probably, no matter how much money you're making, are going to be considered rich, and I'm going to show you why. All right, but Biden wants to do it for the rich, apparently. Now, like I said, you probably heard about this last week because it rocked the markets. As a matter of fact, stocks slide on report Biden will raise capital gains tax. So a lot of investors are like, well, shoot, if they're going to raise capital gains taxes, I should probably sell right now and take the lower tax rate so that I don't have to pay that higher tax rate in the future. Now, they are talking about taking all the way from 20% right now. It's of an effective rate of 23%, all the way up to an effective rate of 43%. So that means the tax rate are going to double, or almost double at that point. Now let me show you kind of how this breaks down. We can see this is the top combined capital gains tax rates. All right, now this is by state. And the reason why this is by state is because in addition to federal taxes, you also get to pay state taxes. So California, my old state, I would get to pay 56.7% tax. 56. So basically for every $100 I make, I get to keep 43. I get to keep 43 out of every 100. In the state of California. New York is not too far behind at 54. So for every $100 you make, you get to keep about $46. Less than half. Now, of course, this varies. Some states have no state income taxes, of course. Texas, 43%, Arizona, 49%, etc. All right, so that is the first thing they want to do. They're raising the capital gains tax. Now, this is happening. Like I said, it rocked the market. Everyone's dealing with this. So, what if you never sell? Now, I recently did a video talking about how you can retire off of Bitcoin. This applies to any asset. If you don't like Bitcoin, you're not a fan, that's okay. Just substitute Bitcoin for any other asset. It could be real estate, it could be oil stocks, it could be whatever you want. But what if you never sell? Now, editor, go ahead and link that video up here on how to retire off that. So what the rich do, what the most wealthy do, is they buy scarce assets and they hold those assets forever and they never sell them. They do that with real estate. Now, when I had dinner with Robert Kiyosaki 4 or 5 months ago, he said, Mark, I don't pay taxes because as my buildings go up in value, I refinance them. I take debt out. I live on some of the debt. I reinvest some of the debt. And they go up in value. I refinance them. I'm sure most people know about refinancing their house. I'm sure most people know what a cash out refi is. So you take more debt against that asset. It's done in stocks, it's done in real estate, and it's also done in Bitcoin. So what if you never sell the asset? Well, how do they get the capital gains tax? They don't, right? Well, they don't like that idea. And so that brings us to attack number 1. This is what they're coming after right now. They want to tax unrealized gains. Tax realized. So think about this. So I bought Bitcoin. It was worth $10,000. At the end of the year, it's worth $50,000. It's $40,000 of profit. But I didn't sell. But they want to tax the unrealized gains. So now I have to pay tax on that $40,000 difference. It's what they call mark to market. They want to market to whatever the market price is. So now I have to pay tax on the $40,000, but what if I don't have the money to pay the tax? Well, then I'm forced to liquidate my asset to pay the tax. Now, what happens that Bitcoin went from 10,000 to 40,000 or 50,000, and then next year it drops back down to 20? Do I get a refund? You see how messed up that is? Now think about this. Like I said, what about if the assets drop? But what about in an illiquid market? All right, so what about my house? Real estate shot up like crazy. I bought the house for $100,000. Now it's worth $200,000, and now I got to come up with a tax on $100,000 of tax, again at 50%. So I made $100,000 of profit. I have to come up with 50 grand. How do I come up with 50 grand? It's in a liquid market. Now am I forced to sell my house, my home, where my family is? Think about the implications of what this is. Now, if you don't believe me, we can see this all over the news. Of course, Janet Yellen, the new Treasury Secretary, she came in and said that we have to act big. I've talked about this quite a bit. She says act big. Now, we don't know all that it covers, but she is saying, quote unquote, worry about it later is what she said, that they have to act big. And we can see in several conferences that she's had, she has basically told us this in so many words. She said that Treasury would consider the possibility of taxing unrealized capital gains through a mark to market. So like I said, that means they market to whatever the market price is on a regular basis. All right, now that's pretty bad. We see billionaire Howard Marks. He says that this would have a disaster effect on U.S. market. It would make investing less attractive. Now remember, the government does tax policy based off of what they want you to do. So they need people to start businesses. They need people to create products, create services. They need money to invest into new inventions. But who's going to invest in less than favorable situations? And that is the problem. So that's attack number one. But now let's talk about attack number two. All right, now attack number two is something that is being floated around called the STEP Act. Now, anything that has a name like that, you should probably be pretty worried. All right, now what the STEP attack is planning to do is something that is going to affect all of you. Let me show you what I'm talking about. Now, among the most notable changes would be a reduction in the transfer tax exemptions, probably taking effect in January of next year. And basically what it does is it takes $3.5 million per person as an exemption. Anything over that, then you have to pay tax of up to 55% to transfer those assets. All right, now I know a lot of you are thinking, well, 3.5 million, that's the rich. I don't have to worry about that, okay? Well, let me show you what I'm talking about. So under this STEP Act, which stands for the Sensible, they give it these good names: sensible taxation and equity promotion. Sensible, it's so sensible, and it's equity participation for everybody, the STEP Act, right? So the act would tax transfers of appreciated property at death, all right? And it would be treated as a sale and capital gains would be due. So for example, your parents in 1950 bought a home. Your parents were making $15,000 a year. Your parents were not rich. They bought a home. They worked their asses off to pay that home off. They lived in that home. They've died in that home. And now they want to pass it on to you. But now that home is worth $1 million. And now you have to come up with 35, 45, up to 55% of the tax. How can the kids afford that? Now, you might think that's impossible, but take a look at this. Now you understand, I'm sure if you've been watching my videos, that 35% of all the money in existence was created in the last 12 months. That means that prices are going sky high. That's why all three stock indexes are all-time high. Real estate, all-time high. Gold, Bitcoin, everything's at all-time high. They're printing an unlimited amount of money. This is the Case-Shiller U.S. National Home Price Index. This is the price of homes in 1990. This is the price of homes in 2020. So if you bought a home and you held it, the chances are you could be nearing that point. Now, again, this depends on where you're at. Obviously, if you're in, Midwest America, maybe you bought a home for $10,000, it's worth $100,000. Where I'm from in Southern California, my neighbors, for an example, bought a home for $350,000 in the 1980s, right about here. Today, the home is worth $3 million. They weren't rich when they bought it. It was 300 grand. But now it's worth $3 million. Now, how can they pass that on to their kids? Their kids don't have good jobs. They're barely out of college. They're making 40 grand a year or whatever. How are they going to come up with 50% tax, $1.5 million, to reclaim their parents' house that they're trying to pass on to them? Of course, you can imagine how hard that is going to be. So 2 ways they're coming after your money. One, unrealized capital gains. The second, on that death transfer tax. Now, what are we going to do about it? We want to always be focusing on this. We need to guard our wealth. Now, I've talked about this a lot. There's 3 ways you should be focusing on money. One, you need to focus on wealth creation. Make as much money as you can. Second, we need to grow our money, right? That's when we focus on investments. The third way is we have to protect our money. Now, I've said it before, keeping your money is a lot harder than making the money. And I know that sounds ridiculous to people who haven't made it, but if you made it, trust me, it's true. That's why you see lottery winners always go broke. Lots of professional athletes, they go broke. Rappers, singers, things like that always go broke. It's so much harder to keep it. So we always want to be focused on guarding your wealth. Now, how are we going to do that? So the first thing is there's different types of tax structures that you want to think about. So you need to get with your tax professional and talk about incorporating in different states, using different structures, whether those be trusts, whether those be LLCs, things like that, dividing up those assets to keep those taxable rates down. All right, the next thing you want to do is have some sort of asset protection. All right, we want to make sure that our assets are protected, so if somebody were to sue us, we don't lose everything at once. And so again, break those up into different types of corporations. And then the next thing we want to do is we want to think about tax jurisdictions. Now, as I said earlier, California, my old state, I've left the state of California to go to a more favorable tax jurisdiction. Now, people leave California and go to, I think there's 7 or 8 states in the United States that have no state taxes. So they could go to Nevada is a popular one. Texas is very popular, obviously, for Californians. From New York, they're moving down to Florida for better tax jurisdictions, but you can also move out of the country for tax jurisdictions. So you need to figure out what's best for you, but you need to understand the target that's on your back. And regardless of where you're at, you might think that $3 million, that's rich, and I don't have to worry about that. But like I said, you do for 2 reasons. One, the amount of money they're printing is pushing asset prices sky high. So while your home might be worth $500,000 today, in 10 years, it could be worth $2 million. You will be considered rich. The second is, if you think they're gonna stop at the $3 million mark, you are sadly mistaken. They will be bringing this all the way down, coming after all the money you have. So think about this, guard your wealth, focus on these 3 ways to protect your assets, learn how to read and react to markets. All right, now let me know what you think about this. Are you aware of what's going on and are you paying attention? Are you thinking about any way of these 3 things? Leave me a comment and let me know. Also, leave me a question. I'm looking for questions and I'm taking questions asked on this video and I'm making videos about the question on my new channel called Market Disruptors. If I pick your question to be answered on my new channel, I send you $25 in Bitcoin just for asking the question. The link is in the description of this video. Also, join me in a couple days. I'm going live to talk about how the market is changing and what you need to be doing to bulletproof your portfolio to make sure that you can not only survive, but thrive in what's happening next. All right, that's what I got for you today. Give me a thumbs up on this video if you like it. If you don't like the video, I don't know why, but give me a thumbs down. That's okay. But leave me a comment and let me know why. All right, that's what I got. To your success. I'm out.